If you are watching silver closely, today carries weight, not in a dramatic headline sense, but in terms of market structure. What unfolds now has the potential to shape how silver behaves over the next several weeks, not just the next trading session. Days like this do not appear often because they represent moments when volatility, leverage, and physical demand intersect. When those forces collide, short-term positions are exposed and longer-term trends begin to assert themselves quietly. This does not mean silver must surge higher or collapse lower today. That is not the point. The significance lies in stress. Markets reveal their true condition under pressure, not during calm periods, and silver is already under visible strain. Context matters. Silver closed 2025 above the $70 level, a milestone that would have seemed unrealistic for much of the past several decades. For years, silver struggled to sustain prices far below this range. That history alone makes it difficult to argue that the broader trend has suddenly ended. What we are seeing instead is violent price behavior. Sharp rallies followed by equally sharp pullbacks. Movements that punish both bulls and bears, especially leveraged futures traders. This is not the behavior of a complacent or well-supplied market. It is what tension looks like when it begins to surface. Veteran market analysts have noted the extreme volatility that developed into year-end, with massive swings compressed into very short time frames. Alongside that volatility came repeated increases in margin requirements by the CME. Those increases are not arbitrary. Exchanges raise margins when risk rises and when volatility threatens stability. Higher margins reduce leverage. Reduced leverage forces traders to either inject capital or exit positions altogether. Most choose to exit. That pressure falls almost entirely on the paper market. Physical holders are largely unaffected. Today matters because weekly positioning influences psychology. How gold and silver settle relative to recent highs and lows shapes how traders approach the coming sessions. Some view moments like this as turning points. That may be overstated. Short-term price action does not end bull markets. It tests them. Strong trends are rarely comfortable. They are volatile, frustrating, and emotionally draining. That is exactly the environment silver is operating in now. Margin increases tend to arrive late in strong moves, not early. They are responses, not root causes, and they do not alter the underlying structure of supply and demand. Here is where confusion often creeps in. Paper volatility does not necessarily reflect physical reality. While futures prices swing aggressively, physical silver tells a different story. Premiums are rising across multiple regions. In Shanghai, silver continues to trade at a meaningful premium relative to U.S. spot prices. Similar conditions are visible in parts of the Middle East and Asia. That divergence is not theoretical. It is observable. Spot price is increasingly a reference point rather than a final truth. When paper and physical markets diverge, they do not remain disconnected indefinitely. Resolution comes through price adjustment, inventory drawdown, or systemic stress. The timing is uncertain, but the pressure accumulates. This brings us back to the real question. Is the current volatility signaling exhaustion, or is it consolidation before continuation? To answer that, paper and physical markets must be separated conceptually. Futures contracts are leveraged instruments. When margins rise, leverage collapses. Forced selling follows. Charts reflect that selling as weakness. Even though the underlying availability of metal has not changed, the futures market was never designed to deliver physical silver for every contract traded. It functions because most positions are settled financially. That structure works until demand for physical delivery rises while inventories tighten. Under those conditions, confidence becomes fragile. Look at global pricing. If silver were abundant and easily sourced, premiums would compress everywhere. Instead, they are expanding. That creates arbitrage pressure. Metal flows toward regions willing to pay more. Over time, paper prices are forced to respond. Volatility itself is not bearish by default. In many long-term bull markets, volatility increases during the middle phase, not at the end. Early stages are ignored. Late stages are euphoric. The middle is where conflict dominates. That is where silver appears to be now. Structural supply issues have not disappeared. Silver has operated in deficit for years. Industrial demand continues to grow, driven by solar, electronics, electrification, and medical applications. Mine supply does not expand quickly. Recycling helps, but does not close the gap. Once silver is consumed industrially, much of it is permanently removed from circulation. Short-term price declines do not resolve that imbalance. They simply test conviction. Retail investors are not the primary drivers of this market. They matter, but they are not dominant. The bulk of pressure comes from industrial users and large-format physical buyers. These participants secure supply strategically, often well ahead of need. That behavior explains why premiums rise even during price pullbacks. Dealers adjust to scarcity. That is inventory management, not conspiracy. In some regions, the effective cost of acquiring silver approaches levels far above quoted spot prices. That reflects localized demand and limited supply. It reinforces the idea that the global market does not agree on what silver is worth. From a technical perspective, the picture reflects compression and conflict, not collapse. Price is moving aggressively around key levels, not breaking decisively away from them. In volatile environments, weekly and monthly structure matters more than daily noise. Revisiting breakout zones is normal. Healthy trends often frustrate both sides before resolving. Margin hikes amplify this behavior. They create fast drops on thin liquidity. And abrupt rebounds, once forced selling, exhausts itself. What would signal real damage is sustained breakdowns accompanied by falling physical premiums. That is not what is occurring. So while today's session matters, it does not define the future on its own. What matters more is follow-through. Do physical premiums remain elevated? Do inventories continue to tighten? Does east-west arbitrage persist? Those are the variables that shape outcomes. Silver is not a straight-line asset. It never has been. Volatility is the cost of participation. The mistake is reacting emotionally to short-term moves instead of reassessing whether the underlying thesis has changed. At present, it is not. Short-term downside remains possible. Margin pressure may continue. Leverage may be flushed further. None of that alters the long-term math unless demand collapses or supply surges, neither of which is visible. The real price of silver is what buyers are paying to secure metal, not what flashes on a screen. That gap between reference pricing and reality is widening. Such gaps eventually close. The current phase is best understood not as a day trade or a guaranteed outcome, but as a volatile revaluation process. Markets offer probabilities, not certainty, and based on the evidence, silver's structural foundation remains intact, even if the path forward is uncomfortable. Now it's your turn. Do you see this as just another volatile session or as part of something larger taking shape? Share your perspective below. Stay focused on structure, not noise.
Hello everyone, how are you? I hope you all good. So friend, if you are watching silver closely today, crisis weight not in a dramatic headline scenes but in terms of market strategy. What unfolds now has the potential to shape how silver behaves over the next several weeks, not just the next trading session. Days like these do not appear often because they represent moments when volatility, leverages, and physical demand and rest. When those forces collide, short-term positions are exposed and longer than trends begin to assert themselves quietly. This does not mean silver must surge high or collapse lower today. That is not the point. The significance lands in straits. A market survival there through condition pressure. Under pressure, not during call periods, and silver is already under visible strain. Contrast matters. Silver closed 2025 above the $70 level, a milestone that would have seemed unrealistic for much of the past several decades. For years, silver struggled to sustain prices far below this range. That's history alone markets. It's difficult to agree that the older trends has suddenly ended. Thank you so much.